Hi, this is Alex Efros, President and Founder of Athelon Wealth Management. There are many different financial instruments currently available to investors, each with its own benefits and risks. In this video, I'll continue to outline some of the basic similarities and differences between certain types of investments commonly referenced in the media.
Hedge funds are similar to mutual funds in that they are pooled investment vehicles which provide active asset management. The difference, however, lies in the liquidity and transparency when compared to mutual funds. The public disclosure requirements for hedge funds are minimal and often do not provide a complete picture of the underlying investments or strategies being used by the investment manager. Hedge funds often charge higher fees than mutual funds, with 220 being the most common fee structure. This means that the fund charges 2% of assets under management annually and also charges 20% as a performance fee. A fund manager utilizing such a fee structure will generally keep 20 cents of every dollar earned by investors. This policy does not work in reverse, however, as investors are often made to absorb all losses incurred by the fund. In general, direct investment in hedge funds may be limited to institutional investors and individuals who meet certain income and net worth criteria. Private equity investments allow investors to purchase ownership interests in private companies whose shares are not traded on a stock exchange. These shares are often purchased through direct investment into the private entity or through a private equity fund, which invests in private companies as an intermediary on behalf of its investors. Generally, private equity investments offer less transparency than public companies because they are not subject to the same strict disclosure requirements. This means that obtaining timely financial information for purposes of analysis may be difficult and time-consuming. Additionally, private equity investments are generally less liquid and may require investors to commit their capital for months or even years before shares may be sold. As with hedge funds, investments in private equity may be limited to institutions and individuals who meet certain income and net worth criteria. Exchange-traded funds, or ETFs, combine the active management element of mutual funds with the increased liquidity of publicly traded stocks. While a purchase or sale of mutual fund shares may take one business day, ETFs may be purchased and sold within seconds. While some ETFs offer exposure to various conservative investment strategies, others may utilize derivatives and leverage with the goal of magnifying returns for investors. Lately, demand for more aggressive investment vehicles has led to the creation of highly leveraged ETFs, which amplify the performance of an underlying index by a factor of 2 or 3. This means that a 5% increase in the underlying index can result in a 15% increase in the ETF. Such leveraged ETFs are meant to be held only for short periods of time, as they are reset on a daily basis. As a result, long-term investors looking to capitalize on the appreciation of the underlying index would generally be highly disappointed if attempting to use leveraged ETFs to accomplish their long-term investment goals. Real estate investment trusts, also known as REITs, provide investors with an opportunity to participate in the revenue earned from hotels, office buildings, residential properties, interest in mortgage securities, and other assets held by the trust. Essentially, investors act as a conduit and provide the REIT with the capital necessary to purchase the underlying assets with the intent of collecting future payouts. As the process of purchasing and selling real estate can be complex, time-consuming, and costly, REITs often require investors to lock in their investment for a certain period of time before they can exchange their shares for cash. While some REITs are relatively illiquid and non-marketable, there are also marketable REITs that offer additional liquidity and those that are publicly traded on national stock exchanges.
Athelon Wealth Management is an independent, fee-only registered investment advisor. We offer comprehensive investment management services tailored to fit the needs of each individual client. Our process involves creating highly customized portfolios to obtain the desired level of return while also managing risk through diversification, ongoing in-depth research, and portfolio rebalancing. In choosing investments for our clients, we emphasize transparency, liquidity, and value. We also never accept any commissions or referral fees, which allows us to provide investment strategies most suited to the needs of our clients without conflicts of interest. Give us a call at 347-706-1414 for a free introductory consultation with a qualified and experienced investment advisor. You may also visit our website at athelonwealth.com for more information. That's ATHELON wealth.com.